screen, then I'll need a confirmation on the same. If my screen is visible, kindly confirm for me. Is my screen visible? Okay, thanks. So we'll start from where we left off yesterday. So yesterday we covered market structures and we had an assignment that we are supposed to do. So this was the assignment that was expected to be done. So we had the first question: open the Gala USDT trading pair on the 4-hour time frame and identify the following: an uptrend, and when at it, name higher highs, or rather identify the higher highs and the higher lows. Then a downtrend, while at it, identify a lower high and a lower low. Then identify break of structure and market structure shift and name them using the trading view. So I'll navigate very fast to some submissions that I had. So the Gala USDT chart, 1 hour time frame. So this was well done. This was just one submission encompassing all the 4 questions. So this was the Gala USDT chart, 4-hour time frame. Then the first question was identify an uptrend. Here it is, an uptrend, and name higher highs and higher lows. So this is what was expected of you. Identify a higher high, a higher low, a higher high, a higher low, a higher high, like that. Then the second question was identify a downtrend and name the lower highs and the lower lows. So here we have a series of lower highs and lower lows. The third question was identify a break of market structure, or a BOS, break of structure, and a market structure shift, or what we call a change of character. So from this point right here, we are having the market changing, or rather reversing its trend from from a downtrend to an uptrend, and therefore the point at which the market changes its trend, that point now is what you call a market structure shift or a change of character, as it has been highlighted here. So what missed on this chart was just identify the market structure shift, and that was easy. When it comes to a lower time frame, the market structure shift is this part right here. So a line to be drawn. Let me see if I had another submission on the same of a break of market structure. So yes, break of market structure. This is what was expected, to identify a break of market structure. So this was a downtrend. So break of market structure is at this point. And what about in an uptrend? In an uptrend now, let me see if I had another one. The one ain't named, but in an uptrend, here is where we have a break of market structure, a break of market structure, and a break of market structure. Any question on the assignment before we move to what you're supposed to cover today? Any question? If everything is clear, please confirm for me by sending a reaction. If everything is clear. Thank you, Ian. Thank you, Gladwell. Okay. So we'll move straight to what you're supposed to cover tonight. And tonight we're going to cover 2 types of POIs. POIs, remember I said we're going to look at POIs, which is points of interest. So tonight we're going to cover what we call the order blocks and the breaker blocks. But before we go straight into that, what is crypto trading? Crypto trading is the buying and selling of crypto at specific prices in order to make a profit. So there are 2 ways in which you can buy and sell crypto at specific prices in order to make a profit, which are futures trading and the spot trading. But what is the difference now between spot trading and futures trading? So as we have covered before, in spot trading, you can only make money when the market is going up. That's the only way you can make money with spot trading. What do I mean by this? So today I've entered into the market, I've bought BTC at 58K. So the only way I can make money in spot trading is if BTC moves up to a higher price than my initial buying price, which is 58K. So if it moves to 59, depending on my investment margin or my capital, then my percentage will increase in accordance to what I had invested before. So that's the only way you can earn in spot trading. You only make money when the market is going up. But in futures trading, you can make money when the market is going up and when the market is going down. What do I mean by this? So, for example, I predict today in the morning that BTC is gonna buy, and actually, not by buying, I mean that BTC is gonna go up. So I set my buy position. If BTC goes up, then I'll make my money. The inverse is the same. If I predict that BTC is gonna go down and I have my sell position, then and BTC actually goes down, then I'll make my money. And if your prediction goes, if the market goes against your prediction, then I lose that money. So that's the basic, that's the difference between spot trading and futures trading. In spot, you only make money when the market is going up. But in futures, you can make money when the market is going up or down, depending on the speculation that you had of the market. And no wonder here we are saying that spot trading entails speculating the prices of a coin will go up and placing order types. Can you have examples of order types that you can remember? Anyone? Then have a brief description. Types of order types. Just to give you a refresher, we can say the market order. The market order allows you to buy at the current market price. Any other order types that you can remember? Any other order types? Top of your head. Yes, Mugo?
By limit, which
Yes.
allows you to buy at a price which is cheaper than the one which is at the market.
Buy. Sorry, repeat.
By limit, which
Yes.
allows you to buy an asset at a price lower than the one which is currently at the market.
Yes. A buy limit is an order type that allows you to buy an asset at a price lower than the current market price. Which other order type? Anyone else? So I'll just name them, then you can go and check them out. So under the buy, we have the buy market order, the buy limit, the buy stop limit. You can go and check on the notes what they mean. Then you have the buy OCO. And under the sell, you have the sell market order, the sell limit, the sell OCO, and the sell stop limit. So those are the kind of market orders that we have. So moving on to this other part. So, trading strategies. What are trading strategies? This is a well defined approach or a plan that a trader uses to make informed decisions about the market, and it informs them on whether to buy or sell a crypto asset. So, in specific, we have different types of trading strategies. You'll see people on TikTok saying they have their own trading strategies and whatever. So when they say they have a trading strategy, it means it is a well-defined approach. It's like a plan that you do, or rather you follow daily, and it informs your decision about about buying or selling a crypto asset. We have strategies like smart money concept, which is what we are covering. We have price action. We have traders that use indicators and many other types of trading strategies. There are over 100. We have the Elliott's waves and many other trading strategies. But in specific, in this class, we're going to learn about smart money concept, the SMC. So trading strategies are designed to provide a systematic approach to trading, helping traders manage risk, yeah, identify opportunities, and maintain discipline. So these strategies can be based on various factors, which include technical analysis. Technical analysis is everything you do that entails the charts. So that is what we call technical analysis. Fundamental analysis are things to do with the news, the akina CPI that occurred actually today, 3:30 p.m. We have the FOMC news, any fundamentals, maybe is this guy who this guy of Doge, Elon Musk. Maybe Elon Musk has tweeted something. Thank you, Ian. So maybe Elon Musk has tweeted something about Doge. Those kind of things are the things we call fundamental analysis. Things like the crypto, the Bitcoin halving, those things now, the ETFs, the upcoming Ethereum ETFs, those now are what we call the fundamental analysis. So under those types, when it comes to trading strategies, there are things that you look depending on a trading strategy. Remember, you're saying a trading strategy is a plan. So according to your plan, there are things that you look that will inform your decision before buying and selling crypto assets. And those things that you look are what we call points of interest. And we are saying that tonight we're going to cover 2 points of interest. That is the order blocks and the breaker blocks. So let us look at what are order blocks. So order blocks are footprints left by the market when an impulsive move occurs, creating an imbalance. So, and we are saying an order block is the candle before the strong move that creates an imbalance. So if I'm to navigate to my charts, we are saying that an order block is the last candle that is formed before that impulsive move is made. So if we look at this chart right here, we can see that, let me navigate to BTC probably. BTC of BTC USD. So if I'm to navigate to BTC, I'll just use the, so we are saying, remember what we are saying, we are saying that the last candle that was formed before an impulsive move was made. Remember, when you're saying an impulsive move, you're saying it leaves an imbalance. So what is an imbalance? An imbalance is a point that we have many buyers or many sellers without the other in the market. What do I mean by this? For example, if you look at this point right here, we have a zone. This zone, let me use a rectangle to show this. You have this zone where the market only had sellers only. So this is what you call an impulsive move, or rather an imbalance in the market. So we are being told that an order block is the last candle that has been formed before that impulsive move. So in this case right here, our order block will be this one, this doji-like candle, this one right here. Let me have it in a different color, maybe yellow. So this will be our order block, because we are being told an order block is the last candle that has been formed before an impulsive move. And our impulsive move in this case is this zone right here, where we have a zone where buyers did not exist. They are only sellers, creating an imbalance. So that's the first scenario. And another scenario will be, this was the scenario where the imbalance was the place only sellers existed. So also, we can have another example of where only buyers existed. So this zone right here, can have this in red. This zone right here is another example of imbalance where only buyers existed and no sellers were in that zone. So the last candle that was formed before that impulsive move, this one right here, let me have it in yellow. This one right here, oh sorry, yeah, anyway, this one right here, now this is our order block. The one in red is now our order block, because you are being told the last candle that has been formed before an impulsive move, that is what you call an order block. So no. So the order block is the candle before the strong move. So the last candle that has been formed before an impulsive move. And this brings us now to two types of order blocks. We have two types of order blocks. We have the bullish order block and we have the bearish order block. So what's the difference? A bullish order block is a sell candle before a significant buy. So in other words, a bulb or a bullish order block is a red candle. Remember a sell candle is a red candle. So the last red candle before a significant buy, that is a bullish order block. If I'm to go back here now, the last sell candle, the last sell candle before a significant buy, now that is a bullish order block. Let me name it. This is now our bullish order block. Right here. This is our bullish. Let me have it in caps. Order. That's our bulb. In other words, it's also called a bulb. A bulb, like that. Let me lock that. So the last red candle before a significant buy, now that is what we call a bulb, a bullish order block. So the inverse will be the last green candle for a bearish order block, the last green candle before a significant sell, last green candle before a significant sell, then that is what we call a bearish order block, or rather a bulb, a bulb, a bearish order block. Like that. That's our bearish order block, like that. So I repeat again, the last red candle before significant buy, that is a bullish order block. And the last green candle before a significant sell, that is what we call now a bulb, a bearish order block. So as you have been it's been shown here, a bearish order block is the last buy candle or the last green candle before significant sell, as I've shown you. Then we have demonstrations on the same. So for a bullish order block, the last red candle before significant buy, that is our bulb. And as you can see, if you identify a bulb from the market, also I need you to understand, to notice something. So when I came to my charts to map out my order blocks, I included even the weeks. Remember this part here looks like let me try and move this part right here. It looks like a doji candle. So when you're mapping out your order blocks, make sure you include even the weeks. Don't leave out the weeks. For example, if this is your bullish, no, yes, your bullish order block right here, make sure you include the weeks. Let me just illustrate right here. So this is our last red candle before significant buy, so it qualifies being a bullish order block. So if I'm to map out that, I'll include even the wicks from the top here, uh, all the way down to that point, and extend it like that. So make sure when you're mapping out your order blocks, include even the wicks. So that's how you map out an order block, so even or even breaker blocks, which you're gonna cover in the consecutive slides. So as you can see from this illustration right here, the order block has been mapped out inclusive of the wicks. And what does an order block do? So bearing the fact that this is a bullish order block, so the market, to expect the market is going to come down into our zone of the order block before, remember this is a bullish one, so we expect to buy. So it will come tap into our bullish order block before buying. Let's see if that's true. So we have our bullish order block there. If I'm to extend this rectangle tool, let me unlock it. So if I'm to extend it, you'll see that this was actually a really strong order block because it has been retested a couple of times. It has been retested by this candle. All these candles came back because they were retesting the order block. And if I'm to come down here now on this, you'll notice even this wick right here was coming back to retest another order block at this point. So if I'm to draw this order block, bearish, a bullish one, and extend all the way down here, you'll notice that this wick actually came down so that it can trigger this order block, this bullish order block at this point right here. So if I extend like that, you'll notice it came back to trigger the bullish order block before continuing with the uptrend like that. No wonder we are saying from this point that we expect the market, after identifying an order block, expect the market to come down into the zone of the order block before resuming its trend. That's the case of a bullish order block. In the case of a bearish order block, the inverse is basically the same. The last red candle before significant buy, and we also expect that the market, we expect the last green before significant sell is our bearish order block or a BOB. And we expect, after identifying it into the market, we expect that the market is going to come into that zone of our BOB before selling. Let's see if that was met. Okay, at this point, the market, this is a live chart, so we expect the market is going to come into a zone of our bearish order block before going down. But you can try and identify a bearish order block and see if that actually happened. So actually you can use this. So we are saying that a bearish order block is the last green candle before significant sell. So we are having our significant sell right there. Then the last green candle before our sell. So this is our order block. Let me zoom out. This is our order block right here. The last green candle, inclusive of the wicks, like that, and extend it like that. So you'll notice the market went down, then came back into the zone of our order block before selling. And if you look clearly, you'll notice also this candle right here was coming back to another order block on your left. So if I come to this zone right here, I have a green candle right here before a significant sell right here. So it qualifies being an order block. And what type of order block? A bearish order block. So from a bearish order block, we expect the market to come down, go into the zone of our bearish order block. And because it's a bearish order block, from that zone, we expect to experience selling pressure. So it's going to come down all the way like that. So that is basically a live illustration of what is happening, what is being illustrated here. So we have our green candle. We expect that the market is going to come into our zone of the bearish order block before continuing with the downtrend. Any questions so far before we move to how we can trade the order block? Mugo?
So there isn't like a rule of like when a candle breaks the zone and it becomes like a reversal or something.
There are rules. You'll notice when an order block is disrespected, now it stops being an order block and now it's called a breaker block. And we're going to cover it. Also, like I said before, that we are covering points of interest and how to identify things in the chart, from candlesticks to trends in the market, or what we covered yesterday, market structures, to order blocks and everything. So basically what I'm teaching, it doesn't mean that after this class, now you can go and identify order blocks and take your entries. No, you have to look for other confluences. And what do I mean by other confluences? Other POIs that you're going to cover. Make sure that before you take a position, you have at least 2 to 3. The more the confluences, the better. Is that okay? Perfect. So, how do we trade an order block? An order block, on most occasions, remember you're saying most, not all. On most occasions, the market price, or the price, rather, the price tends to come inside that order block. Just like I've shown you, the price will tend to come in most occasions, not all times. In most occasions, the market will come back into a zone of the order block and have your sell from that point. For example, if this is a bearish order block, and if it's a bullish order block, the market will tend to come down to that zone before having a buy. So one can always have an entry where we have the order block, so that once price comes inside, they get activated and trade goes their way. So for example, if it was this zone right here, I've just identified, let me see, For example, I came to the market at this zone right here. I've just identified my order blocks from this point. So what I'll do now, I'll have my sell position. No, not that one. I'll have my sell position from that zone, so that when the market like that, so when the market comes to retest my order block, I can get triggered into that trade, and now then I can sell all the way to my take profit. That's the case of a bearish order block. In a bullish order block, I can have the same. So I can come have my long position tool from that zone of my order block. Also, you can trade. Let me just delete this to show you something. Let me do this. Let me here we have our order block right here. There are three ways you can trade this order block, or rather, there are three ways you can have your entry prices from. So I can have my position tool. I can decide to my entry to be at the tip of that order block. That's, or yes, the tip of that order block right there. 50% of that order block. So 50%, like half of that order block, or the bottom of that order block. So depending on what you want, you can choose where to do it. But me, mostly I take, not even mostly, all the time, I take 50% of that order block. So at 50%, then I can have my take profit like that, so that when the market comes down to retest my bullish order block, I'll get triggered. Then after getting triggered, I can now run, or rather run the bullish trend into my profits. Sarah, you have a question?
Yes.
Okay.
A request maybe.
Mhm.
Can you illustrate with numbers? Because when you say 50% here, 50% here, some of us are getting lost.
What I mean,
Because we have numbers, real numbers.
okay, what I see, let me just do it. We have this, let me use this one that is here. We have this bullish, this bearish order block right here. So you can decide to, remember you've mapped it out using a rectangle. Let me try and move this rectangle so that you can see uh the order block itself. So this is the order block. It runs from this price from 59 up here. Let me draw a line so that you can see. Let me zoom out. So it runs from this zone right here. Uh, Let me have like that. It runs from this price right here, 59 point. Let me zoom out for you guys. Uh, like that. So it runs from 59.641 all the way to this price right here. 58.483. So you cannot be sure where the order block will be triggered at. So you can decide to trade either, this means now you can decide to trade 58.4 58k. You can have your entry at 58 488.91 right here, or you can have your entry price as, let me move this, your entry price as 59.641, or 50% of it. And how can you measure 50%? Use the measuring tool. We covered this. Come from the top of this to the bottom of this like that. It will give you 50%. From the middle line will give you 50%. Have your line right there. Where's my line? Okay, okay. Have your line like that, and at that 50% right there. So you can also have your entry price as 59,059.15. That is what I mean when I say you can trade the tip, the tip of the order block, the top of it, or 50% of it. So you can decide to have your entry prices as the three of them. Is that okay, Cyrus? Either of the three.
Yeah, that helps.
Yes. So
But maybe you could have done it with a complete scenario.
what do you mean by a complete scenario?
This one is not complete. It hasn't come back.
This hasn't come back, but that is no wonder I was using this and saying you can decide
No?
if anyone, in this case, it was so well done. If anyone took their entry price at this tip, they were triggered. If you look at this price, they were triggered. The market actually triggered that point. if they took 50% of it, let's just assume 50% was around that price, they were also triggered. And also those guys who took at the bottom of the order block, which is just right there, they also got triggered. But you'll find some scenarios where the order block hasn't been fully, for example, this one. For example, this one right here. So anyone who took the tip of it right here, the tip of this right here was triggered. 50% also was triggered at that point, but the one who took the tip of it was not triggered right there, wasn't triggered at all at all. So it depends. It depends. And if you miss the trade, don't chase it, just leave it alone. The market will give you more opportunities. Even if your setup was okay, then you decided maybe on this trade you decided to take the tip of it and you are not triggered, just leave it. The market will give you many opportunities to re-enter into a trade. Is that okay, Cyrus?
Yes, thank you.
Okay, let's do it like that. Wilfred, you have a question?
Yeah. Now, why would someone pick 50%? Is it just their strategy?
Yes.
Like you say, you usually pick 50. Why would you pick 15 instead of the tip
I picked
or,
50.
or the top? Yeah.
Okay, I picked 50 because most times the market will trigger 50%. 50% of that order block, but not all the time. So you'll miss. Remember, trading is speculation. Kwanza when it comes to these things, you don't know. You are very sure that the market is gonna come and retest your order blocks, but you don't know at what point. No one can be sure at what point. But to be safe, I play with 50%. It's just a strategy that I have. There are people who take at the bottom here. So for me, I just take 50%. Is that okay?
Yes, that's okay.
Okay. So we'll move to, I think we have done features of a tradable. Ian, you have a question?
Yes. So what if you decided to do like two entries in this sense? Okay, for example, it's a bullish. What's the word? It's a bullish order block, right?
Yes.
Go back to the nini, eh? So it's a bullish order block, right? And you're sure that itarudi kwenda itest, like it's going to test the order block. So you put a buy there, and then when it reaches, like you put your take profit at the bottom part, and then now you sell again with the trend as it is going down.
I don't get what you're saying actually. Many
Oh,
confused.
ni sawa, acha nianze tena.
Mhm.
Okay, so you have two entries, eh? So the first one, what you will do, so you show that the market is going to test the order block,
Yes.
right? So when it's going to test it, you buy.
When it's going to test it, you buy
Eh,
from the bottom
eh,
here.
yeah, you buy until it goes to test it. So you put your take profit
And
at the bottom part, not in the middle, so that you're safe. Which
also,
you enye uko sure lazima itagonga juu katikati pia inaweza kataa.
I'm getting your point.
Uh-huh.
Actually, when we say order blocks are POIs means that you can have it as an entry point and as an exit point. You get it? For example, let me just do this right now. I've noticed one here. This right here was a bearish, no, a bullish order block, right? So this one was a bullish order block. Let me just highlight it. This was a bullish order block right here. And when you come to our far left right here, we had our bearish order block from this point. Let me delete everything. We had our bearish order block from this point. Where's our bearish order block? Yes, the last red. We had our bearish order block from this point. So what you can do, you can actually, after identifying this, you can decide. Let me even delete this. We have our bullish. Let me name them so that you can see. We have our bearish order. Actually, this is not the one. The last green before significant sell. So this one, the last red, this one right here. The last green, sorry. So this is our bearish order block right here. our bearish order block, like that. At this point, we have our bearish order block. Then at this point down here, we have our bullish order block. So what you can do, you can have, no wonder we are saying order blocks can be used as what do we call POIs? POIs, it means it can be an entry point or an exit point. So in this case right here, one could have used, identify that this is a bullish order block. So you came to the market when the market was around this place right here. So you have identified this is a bearish order block. So after identify the bearish order block, you know that the market is going to come and retest your order block. So what do you do? After, from this point, you have identified your bearish order block, so you know that the market is going to come and retest your order block. So what do? You have your this is a bearish order block, so you'll have your sell limit. Let me delete that, close that. So you'll have your sell at this zone. So you'll have your sell, if you extend this like this, you'll have your sell at this zone with the cell right there. You have your cell like that. And after having your cell right there, you know the market is going to come and retest your bearish order block. Then you can use your bullish order block as your take profit. So you can come and take 50% of this bearish order block right here, or the bottom of it right here. No wonder I was saying, to be safe, it's better to use 50%, because if you notice, if I take the bottom of this bullish order block, my take profit will not be triggered. But if I take 50%, then I'm on the safer route. So I'll have a bearish order block as my entry right here, and I'll also have my bearish order block, my bullish order block as my exit at this point right there. Is that okay, Ian?
Yes.
Yes. So you can use the order blocks concurrently as order the POIs. All the POIs we're gonna discuss, inclusive of FVGs and whatever, all those things that we're gonna cover as POIs, you can use them as entry interchangeably, as you can use them as entries to your trade or exits to your trades. That's the meaning of a POI. So we have covered how to trade order blocks already. So we move to the next part. These are basically examples. This is an example. The last trade before significant buy. Let me slide show from the current slide so that it can be visible. So the last red candle before significant buy, that is what we call a bullish order block. So you can, if you draw a rectangle, remember, draw a rectangle tip to tip for inclusive of the wicks. So if you extend that order block, you'll notice that any person who took this trade from this order block right here, this bullish order block, was retested. And actually this was a really strong order block, bullish order block, because it was retested twice. So it was retested as at this zone right here, and also it was retested as this zone, at this zone, before we head now our uptrend being formed. So you can have your entries from this point, then ride the profits all the way up there. So we have another example of another bullish order block. We have the last red before significant buy. Remember, I said that the significant buy is also known as the imbalance. So the last red before the imbalance. Then also remember that anytime there's an imbalance in the market must come back to mitigate it. Mitigation means the market will come to fill those imbalances. For example, this point, we have a period, or rather a zone, where we had only buyers with no or next to zero sellers, so causing an imbalance. If the imbalance was a green one, it will be mitigated by sellers, because there were no sellers at this zone, so there was imbalance. The market must come down to fill that imbalance, and the process of the market coming down to fill imbalances is what we call mitigation. So as the market was coming down to mitigate this imbalance, it actually triggered our bullish order block from this zone right here. Before we head now, another buy caused by the bullish order block, and also the imbalance that was caused right here, because we have a zone to which we have sellers with the next to nil buyers. So buyers are going to come to fill this imbalance in the process that we are calling mitigation. Is that okay? So if you look at this point right here also, we have the last green at this point right here. this point right here, we have the last green before significant sell. And if we draw a rectangle from this point and extend it like this, we say the last green before significant sell is what we call a bearish order block. The last green, bearish order block. So you'll notice if you do a rectangle and extend it like this, you'll notice that the bearish order block is triggered from this point, causing the market to sell at this point as it was coming to mitigate this. That's why we say always have confluences. So for example, in this place, we have the knowledge of this is a bearish order block. And on top of that, we're not using only the order block, the bearish order block as our only POI. We are looking for other confluences. And the other confluences now is this mitigation. Not mitigation, this imbalance. And this imbalance is what we call this imbalance is now what will cause mitigation. So you'll notice tomorrow we're going to call this imbalance FVG, and FVG is also a type of a POI. No wonder I said every time before you take a trade, make sure you have more than one POI. So in this case, we had our bearish order block, and to confirm it and to make it more solid that the market is going down, we had now this imbalance, or what we call FVG. Yeah. So basically that's how it works. Then we have another, these are basically examples. We have another example of at the last green before a sell. Last green before a sell, we say that is a bearish order block. So we expect the market is going to come, retest our bearish order block before now going down. So because I've already introduced the concept of confluences, if you look at this, you'll notice that we have a bearish order block right here. So on top of having a bearish order block, we had FVGs right here, or rather what we call imbalances. We had an imbalance here. So we know the market's going to come definitely to fill this imbalance in the process that we're calling a mitigation process. So it came up to this point right here, triggered a order block, then sold. Another confluence to confirm our selling is this small uptrend right here. This is what we call a trend line liquidity, but that will cover probably on Monday. Yeah. So that's how we use different POIs and use them as confluences to a trade. I hope that is clear. Any questions? Any questions before we go to features of a tradable order block? Any questions? Ian?
Are there instances where the order blocks are not respected?
Yes. And when they're not respected, now they change from being an order block to being now a breaker block. We're going to cover that in a few. Is that okay, Ian?
Yes.
Okay. So we'll go to features of a tradable order block. So an order block, for us to say that an order block is tradable, it must be at or near the support and resistance levels. So what are support and resistance levels? So let me show right here. So support and resistance. So we'll come right here. Let me draw a line. Let me use actually this, like that. Two lines actually, like that. So we'll name this first one as the resistance. Then we'll name this bottom one as the support, like that. So in the room that you're in right now, I want you to always know that the resistance is your ceiling. Let me even name it here. The ceiling right here. Then your support is the floor. Support is the text. Support is the floor, like that. So if you bounce the ball like this, if you bounce the ball down to the floor, we expect that the ball is gonna do something like this. Delete that. We expect the ball is gonna do something like this, like that, like that. When it comes to the floor, we don't expect the ball to go through the floor like that. We expect that the ball now is gonna bounce back like that. And when the ball reaches the ceiling, we don't expect the ball to hit the ceiling. We expect the market, the ball now, after hitting the ceiling, expect the ball to come down like that. And from that understanding, then you'll be able to what do you call it? You'll be able to now describe what a support level is and a resistance level is. So there are two ways you can define the support level. The first way is the support level is a zone to which we expect a downtrend. Remember, this is a downtrend. We expect a downtrend to come to an end. That's the first way you can describe a support region. That is the zone to which we expect a downtrend to come to an end. Or you can define it as a zone to which we experience buying pressure. Remember, after hitting the support, the market goes up. So it's the zone to which we expect to experience buying pressure. So in the same breath, when it comes to the resistance level is to the zone to which we expect an uptrend. Remember, this is an uptrend. We expect the uptrend to come to an end from this zone right here. We expect that when the market hits the resistance, the 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 uptrend will come to an end. That's the first way you can describe a resistance. And also, you can describe a resistance as the zone to which we expect to experience selling pressure, like that. So the resistance is the zone to which we expect to experience selling pressure, or a zone that we expect an uptrend to come to an end. Basically, that is what we call a resistance and support level. So we are saying that if you find an order block around these zones, the support and resistance zones, for example, in this, let me delete these things. For example, in our resistance zones right here, what do we expect to get? We expect to get, remember, this is an uptrend, so it will be the last green before a significant sell. Last green before significant sell, that's a bearish order block. So from our resistance levels, we expect to experience a bearish order block. A bearish order block from our resistance levels. And from our support levels, remember, this is a sell. Then we have a buy, a significant buy. So from our support levels, we expect the last green before significant buy. Now that is what we call a bullish order block. So from our support zones, we expect to experience bullish order blocks. Is that okay? Is the concept of support and resistance zones clear? Okay, perfect. So that was the first way, the first what we call the first feature of a tradable order block. The second feature of a tradable order block is that the order block should be at or near the flip zone. Before I do that, let me show you a live example of support and resistance in the chart. So let me try another pair. For example, let's see what we'll do. VTC pair. Let's do just pair. We see if we'll identify a support and resistance zone. So 1 hour time frame, okay. Let's zoom out like this. You see, perfect. So if you look at this point right here, you'll notice, and no wonder we are saying support and resistance zone. You cannot use a line, because if you use a line like this, you'll miss some points. It is a zone, so we map it out using rectangles. So I'll come take my rectangle, and if you notice this zone right here, this is my zone of support. This is my support zone. No, sorry, resistance. This is my resistance zone. Look that. Then this bottom zone right here, uh, this bottom zone right here is my zone of resistance. What's happening? Resistance. Like that. This is my zone of resistance. So this is how you identify support and resistance. And if you notice, the order blocks that were within the support and resistance zone, they actually performed so well. So if I come at this point right here, you'll notice that we had the last green before significant sell, and the market actually respected that, came back to trigger that last green before significant sell, and actually sold. If you come back here, you notice, let's try a bullish order block, the last red before significant buy. The market actually came back to retest that before now actually buying. So features of a tradable order block, they should be at Why did I name this resistance? This is actually support. At or near the support and resistance zones. Support, like that. So that's a live example of support and resistance zones. Then the second way of a feature of a tradable order block is that it should be at or near the flip zone. So what do we mean by flip zones? So let me just come here again and do this. So we have it, or let me just use what is here to save on time. I've already covered what is support. We have said that the support is a zone where a downtrend is expected to come to an end, or where we expect to experience buying pressure. This we have covered. We have covered the support and resistance. This we have done, yes. But we are at or at the flip zones. So what is a flip zone? This is where we were. A flip zone, this is a zone where resistance becomes support or support become resistance. What do I mean by this? If I'm to come to this diagram, we have said the support zone is the zone to which you expect a downtrend to come to an end, or a zone to which we expect to experience a buying pressure. And also the resistance zone is the zone as to which we expect that the uptrend is gonna come to an end, and we're gonna experience selling pressure like this all the way down to this point. But what if the market or where the buyers are strong enough and they break through the resistance zone? So now the point at which now the market breaks through the resistance, that is what you call a flip zone. And the moment the resistance has been disrespected, it now stops from being called the resistance zone and it becomes the support. And if you notice, now the resistance moved to this zone up here, shifted to this zone. Now this became our support. Why did it become our support? Remember I said the support zone is where you expect a downtrend to come to an end. And as you can see from this diagram now, the downtrend is coming to an end, then it will take off. So the resistance moved up, then that previous resistance that was disrespected now becomes our support. So the zone to which resistance becomes support or support becomes resistance, now that is what you call a flip zone. We have now the other way where the support is now broken. So we have a resistance zone where we expect the uptrend to come to an end, or a downtrend, or where to experience selling pressure. But on the support zone, we experience that once the market comes to the support zone, we're going to experience buying pressure like this. Because remember, from the definition of a support is the zone as to which a downtrend comes to an end, or a zone to which we experience buying pressure. So, but what happens if the support is disrespected, as you can see this diagram? No, when it gets disrespected, it now ceases from becoming our support zone to now become our resistance zone. And now the new support, if you can see from this point, the new support moves down here, and this support now ceases from being support and now becomes a resistance. So the zone to which now the support becomes resistance, this zone right here, now that is what you call a flip zone. Is everything clear on flip zones? Any questions before you continue on the third way of trading an order block? If everything is clear, please confirm for me by sending a reaction kindly. Perfect. So let's see if we can see a flip zone from just this point. Yeah, perfect. So this support was disrespected at this point. So this zone right here is now what you call a flip zone. And if you notice, this flip zone, now today we are having good POIs. So if you notice this flip zone right here, we have this last green before significant sell. So the last green before significant sell is what you call bearish order block. So if I'm to extend this, let's see if this was respected. If I'm to extend this, you'll notice the market came and right there. The market has actually triggered it twice. So we have We have this respect from this zone, and we also have this point from this zone. So the market actually came back to retest our order block from, and in specific our bearish order block from our flip zone, like that. So that's basically an example from a live chart. So we have the third way. Let me that we get to that. The third way, no, the third way of trading an order block is this. An order block breaks market structure, and this results now to a breaker block. So what is a breaker block? Like I did mentioned, a breaker block is just a disrespected order block. So let's just come here. What are breaker blocks? Breaker blocks are order blocks that are failed, or rather that have been disrespected by the price. So order block is the candle before the strong move that creates an imbalance in the market. So let's do this so that you can understand what a breaker block is. So we'll have something like this. Let's have something like this. You're having an uptrend like that, like that. Then we have something like that. Like that. Can you have volunteers to help us map out? This is an uptrend right here, and this is a downtrend. Someone to help us map out, or rather to identify break of structures and the market structure shift from what I've drawn. Any volunteer to help us name that? Anyone to help us map out break of structure and market structure shift? This is so easy. Come on, guys. Anyone? Ian?
We have a break of structure.
Where?
Where it was bullish. No, the down.
Here.
No, upper. There.
Yes,
This is the
perfect. Here we
structure.
have break of structure.
Yes.
Also here we have another one. A break of structure. Right?
Yes, we also have another one on top of it.
A break of structure like that. Right?
We have a change of character. A market structure, so MSS.
MSS. From what zone?
Below the BOS.
Here.
Yeah.
Yes, correct. We have a market structure shift of the exchange of character. Then
We have another BOS below the CO.
here.
Before the MSS. No.
Okay, yeah, perfect.
Yeah.
Yes, we have the break of structure right here.
And another one below it.
Yes. Let's appreciate here. That was perfectly done. So we have a break of structure. That's a good description right there. So if I come here, let's say on this zone, I want us to identify order blocks on this zone. So before, let me even delete this. Before this significant, remember this is a significant buying, and this is a sell. So this is the last red candle. The last red. Remember this is a downtrend before a significant buy. So there's a last red candle here before we had this impulsive move. So let me use a rectangle to draw maybe that correct. What's happening? A rectangle to draw that last red. So what did we say? The last red before significant buy is called. The last red before significant buy. Last red before significant buy. Last red before significant buy. We've just done this. Last red before significant buy. Yes, Fred.
Bullish order block.
Yes, the last red before significant buy, that is what we call a bullish order block. So this basically here is a BOB, a bullish order block. So on this leg right here also we have a bullish order block. This leg right here, this is a bullish order block also. So we'll have a bullish order block from this leg, bullish order block. And then we'll also have, let me lock that. We'll also have a bullish order block from this leg right here. Like that. We have a bullish order block also from this leg right here. Bullish order block from that leg right here. But what do we mean by a disrespected order block? So if you look at this, so what we expected, if you draw a rectangle from this zone, remember we said that when you identify an order block from week to week, let's assume this is an even head weeks, week to week, you extend your rectangle like this. So what did you expect the market to do? You expect the market to come, respect our zone of the order block, then have a significant delay like that. Ian, you have a question? Okay. So what you expect the market to do is that the market will come, respect this zone of the order block, then have a buy. But what happened is the order block got disrespected. So the market came down and disrespected the existence of this order block. So what does it now become? It stops being a bullish order block. Now it becomes a bearish breaker block. So that is how we come about the word bearish breaker block. So let me just name it now. The bullish order block, after it has been disrespected, it now ceases from being a bullish order block and now it becomes a bearish order block. Bearish order block, like that. Now becomes a bearish order block. And if you can see from this zone now, the market actually respected the bearish order block and now sold like that. So that is how now a bearish order block is formed. So a bearish order block is a bullish order block that has been disrespected. And the inverse is the same for a bullish order block. So we'll have something like, I will have an uptrend like this. And we have something like that. No, not an uptrend like that. Sorry. We'll have a downtrend. We'll have a downtrend now. Like that. Something like that. Then you have something like that. Okay, let's send it there. So we'll have something like that. Let me just pull this down to make it a lower low. So we have our what do you call them? We have our break of structures down here. Break of structure, break of structure. Then you have another break of structure. Then you have our market structure shift, or rather the change of character. Then break of structure in the uptrend. And lastly, our last break of structure, sorry, from this zone right there, like that. So just like we said before, this is a downtrend right here. Before this impulsive move, this is a downtrend. No, rather this is an uptrend right here before this impulsive move. So the last green candle, this is an uptrend before an impulsive move. The last green candle right here, last green, let me have it in green. The last green candle before a significant sell. What did we call it? The last green candle before significant sell. What's the name of the last green candle before significant sell? Anyone? Last green candle before significant sell. Cyrus?
Bearish order block.
Yes, this is a bearish order block. A build, a bearish order block like that. So on these legs right here, we have bearish order blocks. Bearish order block. Cyrus, can you kindly mute yourself, please? Thank you. So we have a bearish order block. Then on this leg also, we're going to have a bearish order block. Let me name it also. A build like that. Let me lock that. So if we come to what do we expect from a bearish order block? We expect that the market is going to do something like this. Come back, respect our bearish order block, and continue the trend like that. But what happened is the market actually disrespected the bearish order block. What did it do? It disrespected that bearish order block. So the bearish order block now ceases from becoming a bearish order block. And now if we name it like this, if we extend it like this, assuming that it has the wicks also, so your rectangles will be week to week, the whole of the thing, wicks and bodies all inclusive. So if you come like that, now the bearish order block ceases from being a bearish order block, and now it is called a bullish breaker block. Bullish, a bullish breaker block like that, a BUBB. That's how now we attain a bullish order block. And if you look at this chart right here, it may not be perfect, but the market actually came back to test a bullish breaker block. I have a question. What is the other confluence? We covered yesterday market structures. What is the other confluence that will confirm for us that this market is going to come down to our bullish breaker block, or this market is going to come up here to our bearish order block? Which confluence do you think, based on what we did yesterday in market structures, what do you think is the other confluence? Any trials? From this zone right here. Let me give you guys a refresher. Remember we said that, okay, Fred.
Should we talk about the fair value gap?
Yes, the fair value gap, that's right. But you haven't covered fair value gaps yet. But that's very, very correct. So we actually have three in this. We have the imbalance, which you call the fair value gaps. So on this leg right here, there's definitely imbalance. An impulsive move will leave in imbalance. So you'll have the imbalance is the same as fair value gaps. So the market will definitely come back to mitigate that imbalance, the FVG. We're going to cover FVG tomorrow. Then number two, we have the bearish order blocks, or rather the bullish order block that has been disrespected. That's the second confluence. The third one that I wanted you to say, based on what we covered yesterday, is that this is a downtrend. The market will always come back to form a high that is lower than this previous high. So it will come back to form that lower high like that. So that those are the three confluences that you can combine. And you come to this zone right here, you'll notice this is an uptrend. So when you notice this is an uptrend, you know the market is going to come down to form a high that is a low, sorry, that is higher than this previous high. So it will come back to form a higher low. That's the first confluence. The second confluence is this disrespected bearish order block, which is now a bullish breaker block. And the third one is this imbalance, the imbalance that was here, or rather what Fred is calling FVG, fair value gaps, or liquidity. You can also call it liquidity. Yes. So the market is coming back. And remember I said the process of the market coming back to fill FVGs or imbalances is what we call mitigation. Mitigation. So let's see what we have not covered. So the third way we said is breaker blocks, and I think you have covered breaker blocks. You have said that when an order block is disrespected, now becomes a when a bearish order block is disrespect becomes a bullish order block. So this is just an example. So we had a downtrend right here. So we had the last green candle before this last green right here. Let me do this. This last green candle, this one right here, before a significant sell, we say that the last green before significant sell is a bearish order block. So we expect the market to come, respect this bearish order block, then go down. But what happened is the market disrespected the bearish order block. And what it did now, it ceases from being called a bearish order block to now becoming a bullish order block. And if I extend this rectangle, notice this white rectangle that was extended right here, you'll notice the market actually now came back, respected the bullish, remember I'm saying bullish breaker block, and actually bought all the way there. So if anyone had this as their POI or their point of entry, they actually took their profits up there. So, and you can see also we have confluences, 2 or more confluences. We have this trend and liquidity we'll cover. Then we have an imbalance right here, which Fred is calling FVG, which the market came to feel. In the process we are calling mitigation before actually buying. And the zone to which it came to, it actually now came to a second POI, our bullish breaker block. So this is an example of the bearish breaker block. I think you have done that already. And this is a perfect example of a bearish breaker block. So the last red before significant buy, we say that is a bullish order block. So we expect the market to come to this zone, then buy. But the market disrespected that. So after disrespecting that, now that ceases from becoming a bullish order block, and now it becomes a bearish breaker block. And if you see from this rectangle that has been drawn, the market respected that. 2 conferences, the mitigation part, the FVG, and now the bearish breaker block. Then the market sold. So that is basically how breaker blocks are formed, or rather how they can be traded. So how do we trade breaker blocks? On most occasions, just like you've seen, the market tends to come inside that breaker block, like we have seen, it comes inside that breaker block. You have seen it comes in this zone, triggers that breaker block. Also in this other example, came into this zone of this breaker block before going up. So that's the way you trade a breaker block. The market will come inside the breaker block before making an impulsive move. So one can always have an entry where you have a breaker block, so that once price comes inside, you can be activated and trade goes your way. So in short, a BB or a breaker block can be used as a point of interest. And we say that point of interest means that it can be used as an entry point or an exit point. And that marks the end of this class. So if you have any question, please, this is the time. Any questions? Any questions? They may look like complicating things, but they may look like complex terms, but it's not even hard. If you rewatch the video and actually try and identify them in the chart, you'll notice it's not so hard to identify these things in the chart. So if you have any questions, please. Yes, Ian.
Okay, mine is on the trading view.
Mhm.
So, like, how did you manage to add the words? Like, no, in yours, you have the names already there. Like, for the change of character, they're there. How did you add them? And also,
Mhm.
how do you also add the line which connects directly to the I don't want to call it the scale, the price at the end, right?
This line right here.
No. There's a line you're picking from your tools,
Mhm.
the green one, which is connecting
That
directly.
one.
Yeah, that one. Yeah. How are you adding them? Because I've tried and honestly mine aren't.
So remember, there's this. I don't know what you can call it. Maybe a favorite segment. This part. So if I want to add anything, most of my tools that I know that I'm gonna use a lot of time. So I'll come to this point right here. Let's just pick any that I don't use right now and see what will happen. So These are the ones that I mostly use. So if I notice that there are things that I need in them, that I mostly use, that I don't need to come and look them on this tools section, I need them here on the, let's call this favorite section. On this favorite section, for me to access them easily, what I do, for example, this three drives pattern, you see this at the end right here? I'll come and favorite it like that. And now it will appear on this zone, on this place right here. So every time I need that, I can easily access it. Instead of coming here on this tools section, I can come on my favorite section and just get them from there like that. So in specific, what you want, let me delete that in specific. And if, for example, if I want to remove that, I'll just come and unfavorite it. So for that line that you're saying, it is located on this second part. Second, after this cursor pointer preference point, the second part right here, you have the trend line, this short one. Then the one that you're asking is the horizontal ray. The difference between the horizontal ray and the horizontal line is this. The horizontal ray, once I use it, it draws a line from the point that I want all the way on my, this is my right, yeah, on my right, like that. So that is the horizontal ray. But the horizontal line, it draws a line from the left all the way to the right. So if I do that with the horizontal line, even if I zoom out to do whatever date, I'll still see that line. So that's the difference between the horizontal line and the horizontal ray. Okay, on the second, what was the second question? I've forgotten.
Oh, okay. Or adding the names.
Adding the names. So what you do, if you want to add the name, for example, let me see, for example, let's say, for example, this is called, we can just fake it. For example, say this zone right here, maybe it's called Ian, like that. So if that zone is Ian, so see, they have named it. So let me go back. I've missed something. Let me delete it. So I draw first that line using the trend line or the any tool you want, even if it's a rectangle. This can be done on any even the ray, you can use it. So if I come there, if I double click on that line, the one that I've drawn or that tool that I've drawn like that, it will bring this dialog box. So I'll go under, mostly it comes under this style. So I'll navigate to the text part. So after navigating to the text plus, I make sure I check this box right here, this text. Then I'll name it whatever I want. For example, here, like that. So after naming it here, I decide the font that I want it to appear in. If, for example, I want it in yellow, you'll notice that it has changed here. Maybe in yellow, the font size, we can change maybe to 16, so it's now smaller. Then you can decide if do I want it in the middle, like it is right here, or do I want it at the top, as you can see what has happened, or do I want it at the bottom, right here. So I prefer mine at the middle. After the middle, I can come here and also choose, do I want it at the center or at the left? If I want it at the left, it will move at the left. If I want it on the right, it will move on the right. If I want it at the center, it will move at the center, just like that. Then I'll say okay. So after saying okay, this box, this dialog box will appear, because I don't want to, every time I'm coming to the chart, I don't want to keep on now writing here and here and here and all the time. So I'll come and save this template. So I'll come here, then save this drawing as here, like that. So after saving it as here, every time I'll use this tool and draw something like that and click right here, I'll have an option because I have saved break of structure, change of character, Ian, resistant, stop hand, support, and trendline liquidity. So I'll have an option of choosing. So in this case, I can come and now name it Ian. Every time I draw that, I can now come, no, trendline. Every time I draw that, I have the option of choosing Ian from this point. Is that okay, Ian?
Yes, I understand.
Yes, that's how you do it.
Okay, a final question.
Okay.
When we analyze using trading view and then we go to execute on Binance or whichever exchange, are the spreads the same? So like, will there be like a diversity kwa ukiseti nini ukiweka wale pardon niko na homa saa hizi
No pressure.
niambie hivyo, will it like hakutakuwa na like a difference in the
In prices.
yeah.
It happens actually. Sometime last year, Binance had that Kashidana trading view where the prices were you had like a difference of like 2 points EV. But now I think that is fixed. That was fixed. Now the price that you take on Binance is actually the price that you take on TradingView is the price that you'll find on Binance. But I find Mexi very very on point. Every point on TradingView is the exact point on Mexi. Also, these exchanges are here to make money, so they can manipulate it sometimes themselves. It's not even a mistake. I actually think it's a manipulation. They can decide to manipulate it themselves kwa sababu mtawanyonya pesa muwamalize.
Okay, ni sawa. Na like how
Eh,
okay on Mexi, when you go to execute on Mexi,
mhm.
chill, what was the question? Ebu chill kiasi. Let me phrase my question again kiasi. Oh, on trading view, like how can you put your buy limits?
No, on TradingView is basically you cannot have your entries on TradingView. TradingView is basically an analysis tool.
I get that, but like how do you get them? So that okay, like in time nimepata point yako. Ama alerts inaweza work.
You can use alerts to
Eh,
alert you ikikaribia your entry so that you can go and set that on your exchange.
it's a hiding.
Okay. Any other questions? Okay, if no questions, then I'll end this class from this point. We meet tomorrow for FVG, stop hunt, and the Cosimodo level. Anyway, guys, have a good night and blessed time. Bye bye, guys.